Hey everyone, and welcome to GD Investments, the channel where you'll learn to invest like a pro. Ever hear people talking about the market going up or down and just nod along, secretly wondering what on earth they're actually talking about? You know, stocks, shares, bulls, bears, sounds like a zoo, right? Well, buckle up, because today we're demystifying the stock market. Okay, so what is the stock market? Imagine a giant, super organized marketplace. But instead of buying apples or antiques, people are buying and selling tiny pieces of companies. These pieces are called shares or stocks. Think of it like this. Let's say your friend Brenda bakes the most amazing biscuits. Brenda's brilliant biscuits is a hit. She wants to expand, buy a bigger oven, maybe open another shop. But she needs money, capital, to do that. So Brenda can decide to go public, which means she offers to sell small pieces of her company, shares, to people. When you buy a share, you become a part owner. A tiny, tiny owner, but an owner nonetheless. Why would Brenda do this? Because by selling shares, she gets the cash she needs to grow her business without taking out a huge loan. More ovens, more biscuits, more happy customers. And why would you buy a share of Brenda's biscuits? Two main reasons. First, if Brenda's business does well and makes a profit, she might decide to share some of those profits with her shareholders. That's called a dividend, like a little thank you bonus. Second, if Brenda's brilliant biscuits become super successful, more people will want to own a piece of it. This demand can make the price of her shares go up. So the share you bought for, say, $10 might now be worth $15 or $20. You could then sell it for a profit. So, where does all this buying and selling happen? In specific places called stock exchanges, like the New York Stock Exchange, NYSE, or the NASDAQ. Think of them as the officially organized parts of our giant marketplace. Nowadays, a lot of this happens electronically, of course. And how are prices decided? It's all about supply and demand. If lots of people want to buy shares of a company, high demand, but not many are available for sale, low supply, the price goes up. Like a hot new video game console. Conversely, if more people want to sell than buy, the price tends to go down. You usually don't just walk onto the floor of the New York Stock Exchange to buy shares. Most people use a broker, a company, or a person licensed to buy and sell stocks on your behalf, usually through an online platform. You often hear things like, the Dow is up today, or the S&Amp Wink with tongue sticking out 500 hit a new high. What are these? These are stock indexes. Think of them as a report card for a big section of the market. The S&Amp Wink with tongue sticking out 500, for example, tracks the performance of 500 of the largest US companies. If on average, those 500 companies are doing well, the S&Amp Wink with tongue sticking out 500 goes up, and people say, the market is up. It gives us a general idea of how the overall stock market is doing. So, who are the main characters in this stock market drama? 1. Companies or issuers like Brenda's Biscuits. These are the businesses selling shares to raise money. 2. Investors. These are the buyers. This includes individual investors, often called retail investors, that's people like you and me, buying shares for our own accounts. Institutional investors. These are the big players, like pension funds, mutual funds, insurance companies. They manage large pools of money and invest on behalf of many people. 3. Brokers and exchanges. We've met them. The middlemen and the marketplaces. 4. Regulators. Think of them as the referees. In the US, the main one is the SEC, the Securities and Exchange Commission. They make sure everyone plays fair and transparently. And 5. The news and AMP, the economy. Things like interest rate changes, inflation reports, company news, technological breakthroughs, even global events can all influence investor confidence and, therefore, stock prices. Okay, cool, but why should you care? Well, the stock market is a pretty big deal for a few reasons. It's a major engine for economic growth. It allows companies to get funding to innovate, expand, and create jobs. For individuals, it can be a way to grow wealth over the long term, potentially outpacing inflation. Though remember, investments come with risks and can lose value too. And it's often seen as an indicator of economic health. A rising market can signal confidence in the future. So, there you have it. The stock market, in a nutshell, is a place where people buy and sell ownership in companies. You'll see prices bounce around in the short term, often due to big players making moves or the latest economic news. But here's the key: over the long run, what truly drives a stock's price up or down is how well the company itself is doing, specifically its profits. The more profit a company generates, the more valuable its shares generally become. And this entire system plays a huge role in our economy. It might seem complicated, but hopefully, it's a little clearer now. What other financial mysteries do you want us to unravel? Let us know in the comments below. And hey, if you found this helpful, don't forget to hit that like button, subscribe for more easy to understand explanations, and ring that bell so you don't miss any of our videos, and keep on learning how to invest like a pro. Quick disclaimer, this is all for fun and learning, not financial advice. Always do your own research or talk to a professional before making investment decisions. Thanks for watching, and see you next time.